Alright guys, for crypto banter, the vision is extremely clear, and honestly, very appealing. They tell us, stay calm, everything's normal. According to their theory, with Elliott waves, we've finished the correction, wave A, and we're ready for a violent rebound, the famous wave B, which should shoot Bitcoin straight to 100,000, or even 109,000. For them, this drop is just a gift, an opportunity to buy altcoins at a discount before the real alt season. All very nice, but pure technical analysis is telling us something else. While Banter talks about new all-time highs coming soon, almost as if they're guaranteed, the chart shows us that we're hanging by a thread. I don't see a clear highway to 100K, I see a fragile structure that's struggling not to collapse. Let's take a look at it together with our collaborator.
The Fed has officially announced the end of QT, and we all know what that means. Meanwhile, Bitcoin is reclaiming the Asian range, mirroring the price action of the dollar against the yen, a sign that investors are pricing in either fear or relief from carry trades on these charts. At the same time, MicroStrategy's chart looks like a Trump family meme coin, and good old Michael is getting caught in the eye of the storm. In today's video, we'll try to clarify what the end of quantitative tightening really means, and try to understand how the markets might react. My name is Bedroom Trader. Every day I analyze the markets and explain how I'm going to approach them. Hello, and welcome back, my favorite traders. I hope you're all doing well. Quantitative tightening has officially ended. Good old Geronimo, back from Ibiza, walked into the Fed offices with his supreme money-shooting guns and said, "You know what? That's it. There's not even a penny left in the overnight reverse repos to cry over." Christopher Waller's warnings are justified. So now it's time to put two things on the table. Number one, so maybe there really was a liquidity crisis. The liquidity crisis that wiped out almost 37% from BTC in just a couple of months. And spoiler alert, might not be completely over yet. And number two, maybe gold shows that central banks and institutions had already foreseen this, and were getting ahead of the game for the checkmate that the Fed just suffered. They have failed miserably to normalize their balance sheet, and now, squeezed by the government's fiscal dominance and this massive $38 trillion of debt, there's no other solution left but to print their way out, with rising inflation and a widening gap, a growing inequality between the real economy and the speculative economy that will eventually have to converge again. So in today's video, we'll try to understand what the end of quantitative tightening really means and what a possible start of quantitative easing could look like, so we don't end up like the fools who celebrated Tony Dovish at Jackson Hole last August. This, just to be clear, was the point when the Fed decided to be a bit more accommodating, and we'll try to identify some critical points on the BTC chart. Usually, imbalances tend to get filled, and considering that yesterday BTC, in the same situation and at the same time, was showing a bit of weakness, getting aggressively rejected here on the 15-minute chart by the 50 EMA, already breaking through the Brinks low and heading to break the Asian range, the Monday Asian low. The reason I told you I was watching the Nasdaq Brinks before making a move was exactly this. I saw the possibility that the Nasdaq would at least recover part of this imbalance. Bitcoin was showing signs of weakness, so I said, if the Nasdaq goes down here, Bitcoin is going to crash. And so, confident in this theory, I went short. I opened the trade here at 85,999 and closed it here at 83,926 and some change. After that, I didn't look for any more orders, but instead, I had prepared some positions in case this turned out to be a breakdown, retest, and then a further breakdown. In fact, to be safe, you would generally open the short around here, once confirmations are fully in. As for further longs, I'll wait a bit to see if they eventually establish a range around the lows of the Monday Asian session, and then we'll see what happens. Anyway, the news of the day is this. The Fed has officially ended quantitative tightening. Now, it's very likely that from here on out, the narrative will become polarized and simply turn into the Fed is forced to print, we're going to the moon. Now, the people who might tell you something like that are probably the same ones who, back in August, celebrated the dovish Tony after Powell's speech at Jackson Hole, when he basically announced the start of a series of interest rate cuts. And to put it better into context, we were right around here at that time. Oops, I made a mistake. I meant to use the other arrow. Bitcoin pumped that day, then gave it all back, then had a blow off top, and after the it printed post news, it is now dropped by 36%. And in August, the narrative was this: interest rate cuts are starting, Bitcoin is going to $150,000, and now things will probably be very similar. This will be the narrative that signals the end of the dip and the start of the run toward $130,000, $140,000, $150,000. Will it really be that simple? Who knows? You'll have to judge for yourselves. But first, we need to understand more deeply what the end of quantitative tightening really means. After 3 years of attempts by the Fed to try to clean up its balance sheet, yesterday Powell had to admit defeat, because if he kept going down this path, something would inevitably risk breaking. Since 2022, the Fed has effectively pulled $2.4 trillion out of the markets. And how did they manage not to make everything crash right away? They drained what's known as the emergency reservoir, called the overnight reverse repo. That reservoir is now empty, finished. There's no more cash left. So the buffer liquidity has run out. This means that every dollar taken out of reserves right now is being taken from bank reserves. If you've been following this channel for a while, you know that something we've said over and over is that this M2, this much talked about money supply, was supported by private credit, not by various quantitative easing programs happening around the world. And what does this mean? It means that if the money has to come directly out of bank reserves, it'll be much more complicated and much more expensive to access it. This is also why the carry trade is particularly scary this time around. Because, as we said yesterday, it could bring to light not just the speculative games of investors, but also all the liquidity holes that exist in the system right now. And at this point, the warning from Christopher Waller, a member of the Federal Reserve Board of Governors, is becoming more and more prophetic. He says, we cannot afford to let bank reserves fall below 2.7 trillion. And right now, we are at 2.9, almost at the breaking point. Just one step away from another 2019, the year when there was a severe liquidity crisis. So our friend Jerome is currently in a very complicated situation. It's not just about cutting interest rates and trying to balance the potential stagflation squeezed between fewer available jobs, rising unemployment, and also rising inflation. Instead, we're talking about much more serious issues here. Namely, the failure to normalize the Fed's balance sheet and the checkmate posed by the United States national debt. Therefore, yes, in the long run, it's highly unlikely that they won't end up printing new money. Let's be careful, because this situation is exactly like artificial intelligence. Between the early days we're in now and the utopian scenarios, like Elon Musk claiming that in 20 years, thanks to AI, no one will have to work anymore, there are things in between, like Amazon layoffs that leave 30,000 people out of a job. And for Bitcoin, it's the same. This end of QT, this promise to start printing liquidity, will almost certainly happen. And Bitcoin will almost certainly benefit from it. But from what point on the chart will this theory start to be appreciated? That's a whole different story. So from now on, protect yourselves with critical thinking. Not with cynicism, but with critical thinking when someone talks to you about quantitative tightening. And above all, remember that you don't need to be bullish if you're short. Anyway, this whole quantitative tightening thing made me think about Tether, which we were just talking about the other day. Because paradoxically, while good old Geronimo and the Fed have run out of cash and can't keep the mess that is the United States afloat anymore, paradoxically, Arduino, with fewer than 100 employees, has built a company that makes more money than Goldman Sachs. And while even foreigners are selling, he's still managing, at least in part, to keep the US Treasury market afloat. In fact, quietly, Tether, you can't even really call it crypto anymore. It's something more. Holds $181 billion in reserves. They have more US debt than South Korea and more gold than Australia. And on top of that, just to cover all the bases, they also have 100,000 Bitcoin. And while the Fed is basically fighting against the fiscal dominance of US debt, Tether has actually become the 17th largest holder of US debt in the world. It's a private central bank, period. And Genius X has basically helped create this financial paradox where there are two sides to Tether, the one regulated by Washington, and then there's the offshore side, the USDT we all use every day. And it seems more and more to me that at the moment when the Fed, the central bank, actually has its hands tied, Tether can move left and right a bit as it pleases. On the surface, it's blocked by Washington. But in reality, Washington actually relies on the offshore side of Tether. They're basically privatizing the dollar, entering this new system, using crypto to insert the dollar into every aspect of daily life for people even outside the United States, essentially creating a privatized dollar backed by hard assets like gold, Bitcoin, or debt. We definitely can't say we're not living in interesting times, at least in the markets, because what's happening is a real regime change. As for good old BTC, no one is really asking it to make any particular effort. Very well done for managing to get back inside the ASIN range. Right now it's resting on the lows. So for today in particular, as long as it holds 86,330, and for the week, as long as it holds 85,660, the chances get stronger that it will recover at least part of this imbalance, at least 50%, up to the 89,500 area that was left during Monday morning's dump. Overall, I wouldn't stress out too much about it. I'll see how it behaves and act accordingly. I was also taking a look at the altcoin situation right now. There's still not much to say, but this HIP ETC here seems like they're trying to establish a bottom that's actually really precise, almost to the millimeter. Every candle basically closes at exactly the same level. Here on the daily time frame, it could be a good signal to break above this 50 EMA and start a possible phase of Ethereum outperforming Bitcoin. Definitely, on the daily chart, Ethereum looks really weak. Let's see if over there as well, there will be enough strength to complete this V-shaped reversal and possibly recover some of the imbalances left behind. That's all for today's video. Thank you for staying with me until the end.